The way we'll look at any market, and the things we're going to talk about today are applicable in any market, any time frame, okay? And we could be talking about markets today. We could be talking about markets from 50 years ago or 50 years from now. Supply and demand doesn't change, okay? A little review here. Area A on this chart, okay, we have prices just trading sideways candles on the chart, right? Supply and demand appears to be in balance during period A. Okay, price stability, every buyer, there's a seller at that price. All of a sudden at B, what happens? Price moves higher, it rallies. What's the only reason, what's the only thing that can make price rally at B? Let's get people involved here. Why does price move higher at B from price level A? What's the only reason? We could talk about indicators, oscillators, news, you name it. More buyers and sellers, that's it. I know it sounds almost childish to talk about it like this, but try to keep it this simple for a little bit and bear with me, okay? Prices rally from A at B because there are more buyers and sellers at A, okay? In other words, demand exceeds supply at A. While during period A, it appeared that supply-demand was in balance, it actually never was, okay? And it never is. It just takes a certain period of time for this unbalanced equation to play out. B tells us subjectively there's more demand than supply at A. Therefore, at C, okay, C is the first time price revisits this level, okay? So price is revisiting a level where we already know demand exceeds supply. C is where we would expect prices to turn higher. That's where we want to buy into this market. Okay? All right. Okay. Pretty simple. If you looked at my trading and look back over the years, every single buy that I take looks exactly like this in any market. Okay. Understand at C that prices, again, revisiting a price level where demand exceeds supply. Therefore, it's likely to rise, and it does. Okay. Let's move on here. Okay. Now, what's very important in trading, again, keep it very simple. Let's take a look at this here. What I noticed on a trading floor for years, okay, and off a trading floor, is there are simply two groups of people out there. The very small number of people that actually make money consistently speculating in markets, and the very large number of people that consistently lose money speculating in markets. Okay? And when I saw on a trading floor, when you focus on the consistent losers, they all make the same two mistakes, and they're very easy to see on a chart. Okay? And here's the mistakes. Okay. Number one, they sell after a period of selling. Okay. Instead of selling at the top there, they sell right at the bottom of that decline, the red candles there. Number two, they sell at price levels where objectively demand exceeds supply. Okay. All right. Okay. Everybody understand that? All right. So if you consistently sold after a period of selling and sold into price levels where demand exceeded supply, what are the chances that you're going to make money on those sales? Hopefully everybody can see this. All right, what are the chances you're going to make money after selling, selling after a drop in price, selling into a price level where demand exceeds supply? Probably not good. You're probably going to lose most of the time. Therefore, we say, okay, we agree with that. Let's just come in and take the other side of that trade. All right? And that's what the consistently profitable traders, buyers and sellers of anything, do. They simply take the other side of the consistent loser's trade. All right? This is high probability trading, low risk trading, high reward trading. All right? When prices decline, let me go back to that one we just looked at. Okay. So when prices up here, again at C, decline back to C, right down there, we want to ask ourselves, okay, our rules are telling us to buy here, but who are we buying from? Ooh, let's investigate the seller that we're buying from. We're buying here at C from someone who is selling after a drop in price and selling into a price level where we already know demand exceeds supply. Does everybody understand that? Okay. How do you know that? I see a question here. How would you know if buyers are not exhausted at C? Okay. So you're saying, I guess the question is, how do you know that there's buyers there at C? Is that the question? If that's the question, all you have to do is look at B when prices rally from A. Okay. Well, everything once A and B happen, we don't need any more information. We just sit and wait. I use limit orders. I'll put a limit order back down there around C. Okay. Maybe prices will come back in 5 minutes. Maybe they'll come back in 5 days, 5 weeks. Depends on the time frame and type of trader you are. Okay. How do we know the buyers are still there at C? Well, why did price rally at B? Okay. Price rallied at B because there were too many buyers at A. Okay. And how do we know that for sure? Because if supply and demand was in balance at A, you never would have moved higher at B. You'd still be trading sideways. But because there were more willing buyers at A than sellers, price could not stay in that range at A. It couldn't. It wasn't possible. It had to move higher. Demand exceeded supply. Okay. Give me any time frame you want. It all depends. If you're a more active trader, you're going to use the smaller time frames. Bigger picture trader, you're going to use the bigger time frames. Okay. How do you know demand was not satisfied? Because prices moved higher. Okay. All right. If there were an equal number of buyers and sellers, price never would have moved higher as it did. All right. Now I'm going to give you one more question here, and then we'll move on. So what explains the giant run of people buying when they weren't buying before? I think you're saying when they weren't buying before, meaning A, right? Because prices were just kind of sitting there. Is that what you're saying? Okay. Well, there were a ton of buyers before. It's just that while prices stayed there, there were enough sellers to satisfy those buyers. But what happened is, as soon as the last seller at that price level sold, at any price level, when the last seller sells and you have even one buyer left over, what has to happen to price? Okay. Has to move up. All right. Let's keep plugging away here, and I think you'll get this. Okay. Now, while the rules and everything with this are very simple, why is it so difficult? Okay. Why do the masses have such a hard time with this? Well, you have to understand that anytime prices decline into a price level where demand exceeds supply, where you want to be a buyer, where the risk is low and the reward is high, it's never going to happen on pretty green candles. Okay? It's never going to happen with good news. There's almost always going to be a move lower. Well, there has to be a move lower in price, always. Okay? Things like that. All right? Price doesn't decline. When prices decline into levels of demand where you want to be a buyer, okay, the natural invitation is never to buy. Okay? Emotionally, it's very difficult to do this, to operate properly in markets. All right? And it's because of these reasons. Okay? Yeah, at the top of B there, yeah, there were some more sellers and buyers, but we'd have to look to the left to see that. I see this next question here. I don't know the difference between artificial buy demand and genuine buy demand. In my mind, demand is demand. I mean, if there's a buyer, there's a buyer. If you're talking more of like a level 2 thing, that's a different story. Okay. All right, so this is what makes this quite difficult for everybody. Most people are not comfortable buying after a drop in price. Okay, they want to see confirmation of a lot of buying. They want to see upsloping indicators and oscillators giving them buy signals. But obviously, all those things lag price. Therefore, they're not gonna come until the risk is higher and the reward is lower. Okay. Let me go back to that here. 1 second. And try to get a lot of these questions while we're moving here. This question is: are you saying that the $20 and 50 area is resistance where people won't sell below? No, I'm saying that's actually a support level. It's a demand level. Okay. Again, A represents it looks like supply and demand is in balance there, right? For every buyer, there's a seller. Prices are trading sideways. But as soon as prices start to rally from that level, we know that that last statement is actually not true, okay? The move higher out of the level at 2050 tells us subjectively there are more willing buyers than sellers at 2050, okay? There weren't enough sellers to keep price there. There were too many buyers, all right? Therefore, if and when price revisits this level for the first time, that little circled area, again, we know that someone is selling after a drop in price and right into a price level where demand exceeds supply. The lowest probability trade you could take is to sell there. We simply want to identify that and be the buyer to that seller. Okay? Another thing that makes it so difficult is that typically people load up their screens with lots of indicators, oscillators, all kinds of stuff, including news. Okay. Both of these charts are actually the same chart. One is just looking at price. The other one obviously has a lot of indicators, oscillators. I like to call them illusion creators. Okay. People use these to look for buy and sell signals, for confirmation. Okay. If you look at the chart on the right, again, the area A, prices stay sideways there for a short period of time, and then you have a pretty nice rally out of that level at B. Again, when price comes back to that level for the first time at C, we know that price is revisiting a price level where demand exceeds supply. We want to be a buyer there. The risk is very low. The reward is high. C is the low risk opportunity to buy. While we could see that same picture over on the chart on the left, you could see that when you start adding a lot of indicators and oscillators and things like that, not only does it distort the picture, but it actually covers up all the information you really need. Okay. You're gonna make your money. I'm just reading a quick question here. Okay. You're going to make money on the turn. The key in trading anything. Okay, here's the key. The key. I don't care what anybody says about all kinds of different ways to trade and indicators and others. The key to making money in any market is getting as close to the turn in price as possible. And a lot of people will jump in and say, well, that's just picking tops and bottoms and blah, blah, blah. We're not just picking tops and bottoms. A lot of times we'll get very close, and sometimes we're not picking every top and bottom, and we're not getting every turn in price. We're focusing here on the highest probability turning point and diving into the logic as to why that is true. Okay? I don't care what you trade. Stocks, futures, Forex, options, you name it. The closer you can get to the turn in price, the better. And if you've ever spent any time on a trading floor or ever watched how order flow works, it's very obvious. You could see very clearly exactly when prices are going to turn. Okay? When I would be on the trade desk, and let's say we're doing let's say I was looking at the working the yen futures that day, and I had a ton of sell orders to sell at 95.50 in the yen futures. Okay, I'm just throwing numbers out there, and let's say the market opened up at about 9,500, and I look down at all my stacks of orders that I've just now organized according to price, and I see that I have the biggest stack of orders is to sell at 95.50. Well, somebody tell me where resistance is. Where's supply? What price? Market's opening at 9,500. Well, the largest stack of sell orders in front of me is at 95.50. 95.50. Do you care? Does it matter what any big, what the head of the Bank of Japan says, or Alan Greenspan at the time, what he says, or any indicator or oscillator? Does any of that stuff matter? It's not going to change anything. Maybe someone will come out and say something about the yen at that time, and maybe that'll cause prices to move up quick. But still, where are they going to turn? This is all a numbers game behind the scenes. Okay? They're going to turn lower at 95.50. All right? Okay. The key is to not look at these candles and all the squiggly lines on your chart as just red and green candles and squiggly lines. If you can look at them for look at this stuff for what it really represents, it's not that difficult. Okay. Absolutely, Diane. You definitely want to. We've talked about trends here before, and we'll probably talk about it more next time. But the way we quantify, the way we look at trends is a little bit different. Some people in here probably remember from the last few times. The way we look at trends in here is very different than just looking at higher highs and higher lows and upsloping and downsloping moving averages. Because again, that's a very lagging way to look at trends. That's how everybody looks at trends. If you're looking at trends the way everybody else does, you're just buying and selling when everybody else does. There's no edge there. You want to quantify trends in real time. But absolutely, you want to focus on supply and demand and trends for sure. Okay. These charts in here, I've seen a couple questions on this. With these time frames. Some of these charts are larger time frames. Some of them are smaller time frames. It really doesn't matter. You're going to do this the same. Okay. Breakouts, so definitely breakouts are okay. When the breakout is not into a resistance level. Again, it's all when you're trading breakouts, it all comes down to quantifying the supply and demand. Right? That's going to be the difference between the breakout trader who makes money and the one that doesn't. I see one last comment there. The key is being on a floor, someone says. Well, I would certainly, that just, having that experience, just, when I went to a chart for the first time, I knew exactly the information I needed to get off that chart. I needed to find the buyer who was buying after a move up in price and buying into a price level where supply exceeds demand, right? And just the opposite for the other side. Okay. Years later, when I started to see some of these trading books out there and a lot of these trading courses and seminars that are teaching all these, indicators, this and oscillator that, there are, first of all, I thought it was a little crazy, but once I started to see when those buy and sell invitations were occurring, I loved it because the masses are invited to enter markets at the absolute worst time, right? So if you're trained to get in before that when the risk is low and reward is high, well, that's what you want. Okay. Question about the Forex. Yeah, I love the Forex markets. I trade them all the time. If you're talking supply demand, you're never going to find better markets than Forex. Okay. Okay, I'm going to give you a website here in a minute. Okay. If you want more, I'm going to keep moving along here because we always run out of time. There's a website for you. You can go to that website and click on the resources section, resources and education, and you can just click on the PDF icons of the articles. And you can read the supply-demand stuff all you want. Okay. Now, today's focus. Let's jump right ahead here, and let's start looking at. Let's quickly look at these moving averages. Okay. Notice price levels A represent objective demand levels. Okay. Price stability for a short period of time at A, and then strong move higher each time. All right. Notice that lower one. Price spends very little time in that first lower one at A and shoots out of there like a rocket, right? What does that tell us about the supply-demand equation at that level? Is there a big imbalance or a small imbalance? At that lower level A. Big imbalance, exactly. Most people will want to see big bases, right? But think about it. Don't take my opinion for it. Just think about it logically when I explain it, and you'll see how this makes sense. Most people are going to look for big bases on their chart when talking about support resistance. However, now we're dealing with time. The longer price is able to spend at a level, the more time price is able to spend at a level, the more imbalance supply and demand is at that level, right? Right? There's more buyers and sellers for each other, so price can spend a lot of time there. However, the less time price is able to spend at a level, these smaller bases, the more out of balance supply and demand is, right? Right? Price can't stay at levels where there's a big imbalance of buyers to sellers. It's not possible. If you have a ton of buyers and very few sellers, price is going to spend very little time there. It can't, because as soon as that last seller sells, price is going to shoot out of there. Those are the levels you want to focus on, but those are the levels that most people ignore. Okay. All right. So now on this chart, notice the first pullback in price, those areas B. When price comes back into those levels, those are obviously the low risk, high reward times to buy into the market. All right. However, look at that top one, at that top B there. At the time when our mechanical rules have us buying into that market, right, when the risk is low and the reward is high, the profit margin's big, the 20-period moving average is sloping down. Okay. Anybody that uses moving averages to identify trends is never going to buy there. They're going to ignore that buy signal. Right. They're not going to be comfortable buying into that market until prices rally up quite a bit, which means high risk, low reward. Okay. 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 Yeah, someone's mentioning that that top level. You know, when price comes back to that level, second, third time there, it goes down through it. Yeah, we would expect that almost every time, right? When each time price comes back to these levels, the demand or willing buyers that make up that level is decreasing, right? You don't want to take, you know, the second, third, fourth pullbacks to support and resistance levels, supply and demand levels, okay? Willie, we don't really get into that today, but we can get into it next time. I'll jot it down. But just to give you the short answer, the exit strategy is exactly the same. You buy at demand, sell at supply. All right. Yeah, thanks, Boyke there. I see a couple times he's asking people to kind of just, in other words, let's get through this and we can ask questions after. He's been through this a few times, and you know, a lot of times when I always know, I've been doing this for a while, when there's a lot of new people, what we're talking about here is very foreign to most people. But don't take that as a bad thing. the fact that this may be very foreign to you, and maybe it's not, doesn't appear that simple to you, that's a good thing. All right. If this were easy and everybody was doing it, there'd be no edge there. Okay. I'm comfortable talking about it and laying it out there because even though the rules are extremely simple, and making this mechanical is very simple, but I know that most people out there, but if you just sit in front of a screen and try to just push the buttons, emotionally, this is almost impossible to do. Okay, so let's continue here. The second one, B, again, at the time when the at B here, where we want to be a buyer, the 20-period moving average is sloping down, and prices are below the 200-day moving average. Okay, most people are not going to buy there. Most professionals are usually going to say, definitely don't buy this market. We're now below the 200-day moving average. Okay. Well, let's continue here. Yeah, we'll I'll answer questions as long as we can stay in the room here. But also too, you'll have my email. You can send me an email, and usually I get back pretty quick. If I'm traveling, sometimes it takes a little longer. But I'm around for the next for a while here, so I should be able to get back to you pretty quickly. I can also email you a good portion of this presentation if you want that. So just take my email address, and if we don't get to your questions today, don't worry about it. You can send an email and we can chat there. Here we have. Let's focus on this first demand level, the lower one on the chart. Again, cluster of trading prices shoot out of that area. Not only do they shoot out of that area pretty strong, there's a little gap there, which is very nice. Okay. Notice over to the right, the first time prices come back to that level where we want to be a buyer. Okay. No problem. We let prices come into the level. We buy as they're leaving the level with our stop just below the level. Very low risk, very high reward. However, if we're using maybe a moving average crossover as our entry trigger, okay, we are not buying this until very, very late. Notice the black vertical line I put through the moving averages. I did that to identify the cross, just to show you that is always going to give you a much later buy signal than pure price alone. Okay, so you have to be very careful with that. Okay, the upper one, again, base rally, first pullback. Barely touches the level, that circled area on top, and moves higher. That'd be a very nice trade there. But if you're waiting for the moving average cross, you're buying very late, super high risk, and almost no profit margin there. Okay. Those indicators and moving averages and oscillators, they're nice to have on your chart. They may look nice, and they're going to give you the illusion of confirmation, but in reality, it's not the answer. Okay. Believe me, I hope everybody uses this stuff in a conventional manner, but if you want the edge, it's a good idea to either stay away from them or use them the right way, which we're going to get to in a minute. Here's another chart. Again, A represents the objective demand level. B represents the first time price comes back into that level where we'd want to be a buyer. But notice here again, if you're waiting for the moving averages to start turning higher and then cross for a buy signal, you could see that comes way late, and it actually comes into an objective supply level, D. Right? And this is what happens to most people. Right? I can't tell you how many people I see with Forex automated strategies that they've built on TradeStation or somewhere else. They back test them. They come up with these unbelievable numbers on years of trades, and then they start trading it with real money, and they don't make a dime. In fact, they lose most of their money, right? They're lucky if they get one winning trade out of it, right? It's because you know, all they've done is really form fit the they've really just form fit to you know, the best trades in the past. In fact, I've never seen anybody be successful at that. Okay. So hopefully I'm pretty clear here on how the lagging moving averages, the crossovers, come much later after the you know, the ideal buy and sell signals we're getting here. Yeah, KISS there, keep it simple, absolutely. But how many people do you think do that? Hardly any. All right. So enough beating up all these indicators and oscillators. Let's see how we're going to use them to do something proper here. Here's a chart of the yen, and now we're going to combine price with an oscillator like CCI. And don't think that like CCI is one of my favorites or anything. This is how you would use any indicator or oscillator. I've just used CCI as just one example here. Once you've done your work on the chart to identify your supply and demand levels, okay? In other words, here we have a demand level on the left, price shoots out of there. You can see the first time price comes back to that level, dips into the level a little bit. You can see CCI goes oversold there, suggesting that you want to be a buyer, okay? Here's the absolute key, okay? You can use CCI, you can use moving averages, use any indicator or oscillator you want, but only take the buy and sell signals when price is into demand and supply levels, support and resistance levels, okay? You're going to get a ton more buy and sell signals outside of those levels. You want to ignore those, okay? This is how we filter out all the buy and sell signals that don't work from an indicator or oscillator and keep the ones that do, okay? In fact, if we spend a few minutes on this chart, you see the circled area on CCI. That buy signal also comes when price on the chart is revisiting the demand level, okay? But look just to on the CCI, the circled area, look just to the left of that. We also got another oversold buy signal there. But if you look up at the chart, that one didn't pay you anything, right? And if you held on to it too long, you were a big loser, okay? If you look over to the left in CCI, you can see the first two times that that CCI goes overbought, which would have you being a seller. You know, you're about to have an awful day because you're just going to get killed if you sell short there, because price shoots out of there to the upside, right? Okay. In fact, you could spend as much time as you want on this chart. The only real buy or sell signal that works is the one that also lines up with price being into an objective demand level. If you're looking to automate strategies, again, this is how you would do it. The supply or demand level becomes the on-off switch, and the indicator or oscillator's buy or sell signal becomes the actual buy or sell. Okay. All right. I'm going to have to check, Andre, and see what period that is. I have it on another chart. If you could email that question, I'll get back to you. Okay. Absolutely consider longer-term trends. I consider all trends. Just look at trends a little bit different than conventional technical analysis says to look at trends. That's all. Here's another chart. Okay. Again, no, but before let's just start kind of on CCI here. If you look in the middle, you see where CCI goes overbought, right? Goes above the top green line there, and it stays overbought. This is why this is where oscillators break down, and they all do this. Okay? when prices start trending higher on the breakout of that demand level on the chart up there, as they're moving up, the oscillator is going to stay overbought. And if you're looking at that and selling short, all you're going to do is, it's just going to be loss after loss after loss. Okay? But do you understand that? All right? That thing's going to stay overbought until it stops moving higher. Right? In a sideways trading range, an oscillator may be okay, but as soon as prices start to really trend and move strong out of a sideways range, which is, and that move out is when you really want to start. That's where you really can make your money. The oscillator will kill you. Okay. All right. So if we ignore all those CCI signals and only take the one that also that comes when price on the chart is also into a demand level, now we're filtering out all the buy and sell signals that are not going to work, and we're keeping the ones that does. Okay, but the key, obviously, in all this is quantifying the supply and demand, right? Identifying the levels. Okay. Yeah, you could do breakouts. We're gonna look at breakouts in just a few minutes here. We'll get to that. Okay, I just want to show you some of these. Do we use candlesticks? Yeah, I use candlesticks here because that's what just about everybody looks at. But you're looking at a candlestick, bar chart, any type of chart. It doesn't matter. They're all telling you the same thing. Candlesticks are just, I guess, pretty visually appealing to people. At the end of the day, you want to look at it as order flow, right? So trades at price. Okay. These days, with technology and some of the platforms, you don't even have to look at a chart. You can look at all the trades taking place at each price. There's, okay. But yeah, candlesticks are fine. Right. What we're focusing on is price, all the trading at each price level. Right. So here, we're just going to kind of, I'll run through this part pretty quick. Okay. Because this is just the opposite of the demand, right? Here, price is rallying up into that objective supply level. It's a supply level because period A, again, appears to be a level where supply and demand are in balance. But as soon as prices start to decline from that level, we know objectively that they are only falling because at A, supply actually exceeds demand. There are a lot more willing sellers than buyers. When price comes up to area A, on typically good news, right? Maybe good Fed news, maybe some currency intervention, maybe some bank leaders saying something, all uptrend in price, all the indicators pointing up, right? When price revisits that supply level for the first time on all that, pretty good news and nice green candles, we know that we have a buyer buying after a move up in price and right into a level where supply exceeds demand. When that is the case, right? Right? That's where you want to sell short. Okay? Your risk is lowest and your profit margin or reward is biggest, highest. The longer you wait for prices to turn lower up at that level, okay, and you wait for the indicators and stuff to turn lower, right? What's happening to your risk? Is it going up or down the longer you wait for confirmation of lower prices after that circled area? What's happening to your risk? Is it going up or down? All right. And what's happening to your profit margin? Is it going up or down? Right, down. So the key, it's shrinking. So the key, but if you're using indicators and oscillators the wrong way, you're always going to be buying and selling when it's high risk, low reward. Okay. If you wait for all the news to confirm what you're doing, or the candles to confirm what you're doing, same thing. Right? That's why it's so important to enter at as close to the turn in price as possible. When the risk is low, the reward is high. All right. Again, here, just Just about 30 seconds on this slide. Okay. Again, coming from a trading floor, watching the majority of people lose consistently and focusing on the same two mistakes that all consistent losing speculators make. They buy after a period of buying, and they buy at price levels where supply exceeds demand. The laws of supply and demand say you will consistently lose if you do that. Okay. We simply want to identify that. We want to become proficient in identifying that buyer, that novice buyer, okay, who's buying on emotion for all kinds of other reasons. We want to become proficient in identifying that person and simply come in and take the other side of their trade. Okay. Question here, Willie. So basically, you use indicators just as a confirmation when you're approaching your targets. You could. That would be the way to use it. I don't use them, but if you're going to, that would be the way to do it. Like I'll show you an example here. Okay. Right. If you were to use indicators, this is just the opposite of what we saw a few minutes ago with the buy signal in CCI. You would let price come up into that objective supply level up there. And if you need some indicator oscillator to give you some confirmation, you would also look down and see that CCI is also oversold. Okay? I'm sorry, overbought. Overbought. All right, in that circled area. Okay? No, I don't use them. All right. Okay, so, but again, you could see here too, look at the initial drop in price out of the supply level. You see how right away CCI goes oversold? Just giving you buy signal after buy signal as prices are falling? This is why people get hurt so bad using these indicators and oscillators. Okay, they don't understand how they work. Okay, the indicators and oscillators, they have no concept of ongoing supply and demand in the market at different price levels. Okay, there's not an indicator or oscillator on the planet that's focusing on that or looking at that or cares about that. Right? Yeah, I only use support resistance lines, supply demand lines. Okay. But what I'm saying is if you want to add indicators and oscillators, that's okay, just make sure you use them the right way. First, do your support resistance lines, your demand supply lines, okay? And then when price comes back into those levels, given your buy and sell signals, if that's not enough for you, then you can use something like a CCI or an RSI or a moving average or any of that stuff. Stochastics are fine, any of them. Just only take the signals that line up with price being into a level. Okay? Clean chart trading, exactly. I don't know any other way to do it. So, okay. I kind of skipped a few pages here just because I see we're running a little short on time. So I just want to come down to this one. All right. It's just because people I saw a few questions about breakouts. All right. The key to breakouts, okay, knowing whether a breakout's going to work or not. Let's focus on this chart on the right, okay, is knowing where your supply and demand levels are. All right. So if prices break out as they do here on the lower right corner of the chart, we want to simply look to the left. Say, okay, what are we breaking out into? Are we breaking out into a resistance level, or are we breaking out into clean air? Well, here we could see that there is some room before we get to a supply level. So you could take that breakout. I don't like taking breakouts just because there's a few reasons. One, you only know it's a breakout after it happens. So it's never going to be a low-risk entry, number one. Number two, typically you're entering with everybody else. And when you enter with everybody else, there's not a whole lot of edge there, right? But if you want to take them, that's fine. there's plenty of times where I see them happen. I don't enter, but they're fine. They're fine. Just make sure you know what price is breaking out into. That's all. Okay. All right. Taking profits, which we'll get into next time. Okay. You're simply going to take profits into these levels. Remember, we're identifying markets where supply and demand is out of balance, and we're simply trading them back to balance. And these clusters of trading, the bases on your chart that we keep talking about, those are the inventory. Those are the supply and demand. Okay? Diane's asking a question here. Bigger time frames, it seems like you had wide levels. All right? That is absolutely correct. And if the level is too wide for you, you could simply go down to a smaller time frame and look at that same period of time where the level is. And let's say you have a level on a weekly chart that's huge. Well, go down to a daily chart or hourly chart and look at that same level, and what you'll find is that the majority of trading in that level probably took place in a much more narrow range. You'll see that, only see that on the smaller time frame. Okay, so you can tighten up that level quite a bit. Okay, and I know we're kind of running behind here on time, so there's my email address. Okay, sseiden@tradingacademy.com. I teach the Forex class at Online Trading Academy often. It was funny because I was just in Dubai last week doing for an options class. Well, everybody in the room, if I halfway around the world, I'm in Chicago. Halfway around the world to do an options class, but within the first 20 minutes, after talking to everybody in the class, realized that these are all Forex traders. They're there for an options class, but they really like Forex. So I asked them, I said, why do you want to trade options if you like Forex so much? None of them really had a good answer. So, to make a long story short, the options class really turned into a Forex class. It's pretty funny. But anyway, I know there's no speaker coming on. We're kind of running over here. But thanks for your time. If you want some of this presentation sent to you, just send me an email. If you have any other questions, okay.